Ladies and gentlemen, good day and welcome to the CSL Finance Limited Q4 and FY22 earnings conference call hosted by TIL Advisors Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Swayam Pokarno from TIL Advisors Private Limited. Thank you and over to you, sir.
Everyone, and thanks for joining the Q4 and FY22 earnings call of CSL Finance Limited. It is our first time hosting the call for CSL Finance, so a very warm welcome from all of us at TIL Advisors. The investor updates have already been published on the company's website and on the stock exchange. To take us through today's results and the update on the business, today we have with us Mr. Rohit Gupta, Managing Director, Mr. Amit Ranjan, Chief Operating Officer, Mr. Naresh Chandra Varshney, Chief Financial Officer, Mr. Chandan Kumar, Credit Head, Ms. Rachita Gupta, Full-Time Director. We will be starting with a brief overview of the Q4 and FY22 performance by Rohit sir, followed by a question and answer session. I would like to remind you all that anything said on this call that represents any outlook for the future that can be construed as a forward-looking statement must be viewed in conjunction with the risks and uncertainties that we face. These risks and uncertainties have been mentioned in our annual reports. I would now like to hand over the call to Mr. Rohit Gupta. Over to you, sir.
Thank you, Sam. So I welcome you all to the Q4 and the financial year 22 earnings call of CSL Finance Limited. Thank you for taking out the time to attend this call. It is a pleasure to address you all today and walk you through our performance for the quarter and the full financial year 22. First, with the quarter update. Our total income for the Q4 financial year 22 stood at 23.09 crore, an increase of 22% quarter-on-quarter and 35% year-on-year. Our pre-provision profit before tax for this quarter stood at 14.70 crore, an increase of 21% quarter-on-quarter and 15% year-on-year. Our PAT at quarter stood at 10.67 crore, an increase of 23% quarter-on-quarter and 22% year-on-year. For the full financial year 22, our total income for the full financial year 22 stood at 74.8 crores, an increase of 21% year-on-year. Our pre-provision profit for financial year 22 stood at 48.49 crore, increase of 10% year-on-year. Our PAT for financial year stood at 33.45 crores, an increase of 22% year-on-year. Now coming to the balance sheet update. The total disbursement for Q4 financial year 22 stood at 196.60 crores, an increase of 30% year-on-year. Out of this, SME disbursement had an 18% share of 35.57 crores and the balance 82% were wholesale disbursement. The total collections for this quarter stood at 96.94 crores. Collection efficiency has been over 99% for overall portfolio, the highest in past 12 months. Our AUM as on 31st March 2022 stood at 519 crores, an increase of 57% year-on-year. We also witnessed a 38 basis point decline in GNPA to 1.73% as at Q4 financial year 22 compared to 2.11 as at Q4 financial 21. The company has raised equity capital to the tune of 30 crores for a preferential issue to strategic investors, namely Mr. Sanjay Gupta and Mr. Lalit Dua. On the debt side, the company has onboarded two most well-regarded private sector banks, namely HDFC Bank and Kotak Mahindra. The company has adequate liquidity of 27.36 crores, including cash and cash equivalents and undrawn limits as of financial year 22. Our net worth stood at 24% higher than the previous year at 321.49 crores. Now coming to the operational update, to strengthen on our onboarding and underwriting platform for SME business, we have successfully migrated to fully customized and digitalized platform with multiple API integration. This platform should help us to reduce TAT, automate the majority of the underwriting process, thus reducing human errors. Further, to drive growth on the SME front, we have made some key changes such as the CEO coming in our SME division, including zonal credit head and operations head. which will help us to improve our coverage and branch productivity. It is noteworthy to mention that our employee strength has crossed 200 as of financial year 22. We are also witnessing good traction on the resolution NPA cases, where we found legal recoveries through SARFAESI mode as a speedy alternative compared to arbitration award. We have also moved to totally digitalized platform for tracking and monitoring of legal cases efficiently. There is one round of credit ratings upgrade already in place, which we got in November from BBB stable to BBB plus. The company is confident of securing another round of upgrade in the coming quarters. This should help us in optimizing a credit incremental borrowing cost. We also aim to add more lenders in the coming year. The company is also working to achieve a portfolio mix of 40 to 60 retail 40% and the wholesale 60% from the currently 27-73 mix. This target we think we will be able to achieve during next coming 18 months. We have also migrated to fully digitalized loan origination and management platform. Going forward, the focus is to add more modules to improve collections and data analysis. We will also be working on optimizing our cost-to-income ratio in the coming 2 years as we leverage our expanded SME team and achieve better branch productivity. I thank everybody for participating in the call. Your questions are important to us, and we strive to be transparent in our investor communication. Yeah, we can start with the question. This was very brief, so as to take your questions on the Mexican side. Yeah.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nikhil from Securities Investment Management. Please go ahead.
Yeah, hi. Good afternoon. I'm audible?
Yeah.
Yes, sir. Please proceed.
Yeah. 2-3 questions, sir. One is on the schools portfolio. On the call, we had mentioned that we would stay cautious for some time. So how are you seeing the portfolio evolving now? Are you ready to disburse on the school side? Because I think for last 2 years, there won't have been many upgrades or expansion at the school level. So how's and any write-backs we are seeing on that portfolio, because we had taken enough provision. So any write-backs you are looking at it?
Yeah, as you know, the schools were closed for 18 months practically, and most of our exposure is into tier 2, tier 3 schools, which are basically semi-rural. So we didn't do any disbursement till December. Now, slowly and steadily, we are looking at again starting our school portfolio. We have sanctioned 1 or 2 schools in this the current quarter. As of now, how the portfolio is performing, you can say 90% of schools are now maybe paying 1 or 2 EMIs, and this trend we have been seeing for the last 4 months. And we have seen a write-back of 2.33 crores for the financial year 22, and the majority of which are from school. And as our gross NPA has also come down from 12.5 to 8.5 crores. So we have seen a good amount of recoveries, and certain schools which are paying but are still in NPA because their DPD was more than 12 to 15 EMIs, which hopefully I think by end of this year and majorly by end of September, some of the schools which are paying will come out of the NPA. So school portfolio for us has been very good. Till March 20 we had only 1 account in DPD, and going forward still we see that school will be our important segment in the SME portfolio, and we will continue to look and grow in this segment. The whole last 2 years have given us a reasonably good experience and a 360-degree view, and where we never thought that school can we closed. We never had this kind of assessment in our credit diligence that we can close down for 18 months. Even after that, we are seeing that schools are performing reasonably good in spite of what has happened. And being our rural schools semi-rural, we would say that our portfolio is reasonably good. And whatever few cases we are still facing challenge, you can say it's a little learning part also, which was done in the starting phase. And going forward, the school will continue to remain an important segment for us in the SME. Yeah.
Sir, would you say that now, having looked at last 2-3 years, the school... Yeah.
There's a lot of disturbance that is coming from your line, sir.
Hello. Is it better now?
Yeah, better.
Yeah, having seen the performance of the portfolio over last 2 years, 3-4 years, during the COVID challenge and the way it has come back, in the overall SME book, would you say schools as a percentage may increase, the proportion may increase more over a 3-5 years, or would the proportion of mix remain as it is? Because I think this is a more secure and a better portfolio, so that's where I'm trying to understand.
Yeah, because schools definitely have a very predictable cash flows. From that account, schools are very good, and it is only that our focus was not there for last 2 years, and now we have again started. I think in this coming rest of the 9-10 months, we will again start focusing, and what the percentage it will be, I can't say as of now, but definitely earlier we used to target 30 to 35% of our total portfolio in the SME, and yes, I think at least 20 to 25% we will see that it remains in our portfolio to that extent, and it's only that this quarter we have started again looking at it, and the next 9 months will be a little slow on the school side, but going forward we will focus it more strongly within the SME space.
Sure, I'll come back to the queue. Thanks.
Thank you. The next question is from the line of Ravi Goenka from O3 Security. Please go ahead.
Thanks for the opportunity. My first question is, what is the level of penetration in NCR market for us, especially in wholesale side of the business? Are we now adequately present in all the micro market which are targetable, sir?
Yeah, with me, Chandan. He can explain better, and I will also add.
Hey Ravi, Chandan this side.
Yeah.
For wholesale segment, we have captured the complete Delhi NCR market, including starting from the Noida belt, Ghaziabad, and all belts of the Gurgaon and extended Gurgaon too. Palwal and some parts of like Sohna is also covered into that part itself, and we are now expanding our market little to the Chandigarh and that side also. But the research work are going on, and it would be like penetrated into the coming months or coming quarters itself. Right. For micro market, we are covering each and every part of Delhi NCR completely.
Okay.
Apart from those few pockets which we think are not performing or where we don't want to be, we are present in each and every micro market of NCR. Few of the pockets like Yamuna Expressway or a little bit of Dwarka Expressway, we are not so present there, and it is because of our strategic reasons that we still see that traction is not that great. And apart from that, wherever the traction is there, we are fully present in each and every micro market.
Okay. And also in terms of small builders, how many builders are in our approval list, and how many small builders are there in the micro market where we are targeting?
Yes, which we have discussed, that is all about the wholesale big loan. For the small builder loans, the micro market which we are present and targeting is mainly the Gurgaon and the South Delhi market, which is a auto correcting and a high demand correcting market, where the demand and supply is almost equivalent. So for the small builder loans, the target areas are those, Now we have opened some of the areas of the East Delhi and East and West Delhi also, where we are started targeting some of the builders who are good into the networks and other fulfilling our other credit parameters. And we are spreading this builder market itself, small builder market, into these regions itself. So the current target market for the small builder loan is mainly the South Delhi and the extended part of the Gurgaon itself, or major areas of main sectors of the Gurgaon and Faridabad itself.
Okay, I will join in queue. Thanks.
Thank you. The next question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, sir. Congratulations for a very good set of numbers. The question that I have is that we did 196 crore of disbursement in Q4, and that is a significant jump even compared to last quarter and the year on year. So going forward, FY23, what kind of numbers that we are looking at in terms of disbursement?
Look, as a company, we always restrain ourselves from giving any numbers, but we can say that now the COVID has passed on, and last 2 quarters we have seen a reasonable growth in both the segments, even on the retail side. And as a company, we are fully geared up to grow in terms of our team size, our infra, and even our digitalized model on the retail. So we have geared ourselves for growth, and the year prior to that we were more on a consolidation phase where we thought that maintaining our quality of book is more important in those difficult times of COVID. So now we are fully geared for growth, and in terms of market size and all those, we have the ability to capture that market. The only limiting factor I can say is our ability to raise funds at the right cost, and so if those are there, our growth will be reasonable.
Okay. Second question is if you look at the SME loan matrix, the average ticket size in that portfolio has almost doubled from 6 lakhs to 13 lakhs from December 21 to March 22. So is it because a particular segment of that our SME product which we have kind of started dispersing aggressively, and how should we look at the average ticket size in this portfolio?
Sure, Amit will add in detail, but I will just give 2 things. One, we have recategorized one of our portfolio which we used to show in wholesale, which were in the range of 50 lakhs to 4-5 crores, and we have 23-24 crores which categorized as mid-size SME. The 23 crores coming into from that segment, which has skewed the whole the size from 6-8 lakhs to 13 lakhs, and there has been a little strategic shift on the retail also. I think Amit will explain in detail, but majorly the change has come from that mid-size SME left, which has been categorized and shown under this segment.
Yeah, hello, myself Amit, and the question pertains to the average ticket size. Basically, we have redefined the entire product, and as well as the team is attuned to, we are looking forward for those type of clients which are not marginal, as well as, in this kind of, loans which is ranging from 13 to 20 lakhs, we get a client base as well as we get a good collateral also, quality collateral. So the major shift has been to, do quality cases, with good, client having a good cash flow, churning is happening on a daily basis, and they are visible in the market. So that's the shift which we have done, and we intend to maintain that in the coming financial year also. And the penetration in the market is like that, so that all the loans which is coming to us have some kind of vintage in terms of business. At least 4 to 5 years of business they are having, multiple businesses are having, so that the EMI is not impacted. So those kind of strategic changes has been done. We have a good team at all the branches now, and the total model is ready, both in the form of digitalization as well as on the physical front, because in this segment little bit of a touch point with the client has to be there. So the model is ready now. We can do good numbers in coming days, And the LTV, which is loan to value ratio, we intend to keep it up to 30% only. So we are covered at least 3 times of the property. So these are the things which we have kept in the mind, and we have downloaded to the team as well.
Okay, got it. And so another question, Rohit, is that so we are if you look at our balance sheet from NBFC perspective, we are hardly leveraged, right? And we raised 30 crore of equity capital this quarter. So in terms of debt to equity, what kind of first the rationale for raising additional equity, and then what kind of debt to equity level we are comfortable with? Is it 3:1, 4:1? How do you look at that over next 2-3 years?
First, coming to the rationale of raising this small amount of 30 crores, I think you are absolutely right. Otherwise, based on our debt equity ratio, this means no sense to raise equity at this point, and that has been our thought also. But only sometimes you come across good set of investors where you can have a more strategic relationship which helps in your growth of your business. And if that was the basic purpose of diluting our equity to these two both very well known HNIs in the market. And secondly, coming to what kind of debt equity ratio we are comfortable with. As a company, most of the people say that we are too conservative, but that is not has been the situation. So in last 3-4 years post ILFS, we were a little cautious, and the COVID made little things bad for on the retail side. But still, we try to keep our numbers at the bottom line intact, and quality also focused on the quality. And now, as you see that we are focused more on the growth with the platform and everything we have worked on this last 18 months. So the debt equity ratio on the retail side, we think that 1:3 in the immediate 2 to 3 years, and over a longer period of 1:4. That is our internal thought, and on the wholesale, maybe 2.5 times. That is what our thought is.
Okay, got it. I have more questions. I'll come back in.
Thank you. The next question is from the line of Varun Bang from Branston Investment. Please go ahead.
Yeah, congratulations for good set of numbers. So you spoke about your ability to raise funds at reasonable rate. So what is the rate at which we are raising getting financing in the market today, and what more can we do to achieve better credit rating here?
I think the biggest, another milestone we are able to achieve, that is the A rating, and which we are quite hopeful that our numbers warrant that rating. Even in last 1 or 2 years also, there have been sometimes a reservation around our geographical concentration on the wholesale side or customer concentration. That is also now getting reduced with the focus on the small builder loans on the retail segment of spending. And now the confidence of our lenders and rating agencies has also increased on our wholesale book, as they have seen the vintage of last 7 to 8 years, and specifically in last 3 to 4 years, and the way we have been able to come out in the most difficult times, and we have faced demonetization, COVID era, and with all those things. And our next milestone of if we are able to go to A, our ability to raise funds will increase much higher, and we are a little cautious that we don't raise rates at a higher rates, which sometimes certain companies do, and we target below 10%, and still date we are able to raise below that rate only, and HDFC was far better. So I think with the rating upgrade coming, and still we are in discussions and the final stages with 3-4 lenders, and we are very confident, and in this year we will be able to add quite a decent number of new lenders into our book.
That's interesting. And in SME financing, there is lot of focus on cash flow analysis of the SME. So how good is understanding of our ground level staff here, and what are we doing to improve their understanding of cash flows and all other aspects of due diligence?
And just, I was not able to hear the first line on the cash flow. What you want to say?
So in SME financing, there has to be a lot of focus on the cash flow of the SME, particular SME. So how good is understanding of our ground level staff when it comes to these financial metrics, and what are we doing to improve their understanding of the cash flows and also the entire due diligence process?
Yeah, for this, I will update you that the ground level staff as well as at the senior management level, we have taken people from the industry who were doing this kind of businesses for the past 7 to 8 years. So they have a better way of analyzing the client at the ground level, and the same has been done at the credit at the branch level. So every month we have a training on the credit front, whatever rejection has been done in the file, what kind of learning has been done by meeting all the clients on the field, and they are there at the client businesses at least for 2 to 3 hours. They understand what is the footfall, if there is a departmental store, or if it is a manufacturing unit, so they understand what kind of vintage they have as well as what kind of turnover they are having. They analyze then and there, and then we have a regional level credit manager also who visits the particular client, and whatever analysis has been given at the branch level, they are cross-checked. Post that, again, the zonal credit manager also visit that particular client. So all at least 2 to 3 times the client is analyzed based on their cash flow along with the banking, and if the client is also filing returns, we do check each and everything. So based on all these parameters, we analyze the eligibility of the client. Also, we check CIBIL, whatever the obligation is there, how best their track record of the past loan is going on. So every nuances of analyzing a loan has been done. Then only we get into the legal and technical aspect of the property. So it's an end-to-end process through which we give loans to any of the clients which are applying for loan.
Okay. And one more question. Can you explain the ROE tree for SME financing and wholesale financing? What is the NIM and cost of operations, credit cost that we target?
In the ROE on the wholesale side is roughly around 17%, and on the retail side it is around 19%, including the PF and all those. And the second part, the operating cost. Our blended operating cost is around 20% cost to income, and so going forward, we think that we have built a reasonable, but we have a team which we can take it to 1,000 crore without any major addition, even on the cost, and especially at the HO level, and maybe a few sales people may be required. So we don't foresee any substantial addition in our cost to grow ourselves for next 1 to 2 years, and our spending on the infra side, maybe on the technology, maybe on improving our hardware infra and improving the infra of the branches, that has been taken care of during last 9 months. And so we don't, and with the focus on productivity, which was not there because of 6 or 7 months, there was no business on the retail, and our retail has reshaped only from October, November onwards. So going forward, we see that with the productivity kicking up from the retail, our cost to income should come down, and yeah.
Okay. And sir, just one more question. What percentage of our new loans are through DSAs, and what is the DST what we have spoken about in the last con call?
I'm not able to understand this question. New loans, what?
What percentage of our loans are from DSAs?
DSAs, okay. On the retail side, yeah. On the wholesale side, you can say 90% of cases are direct, and only 10% source through from very few established DSAs. And they are not DSAs, I think they are specialized consultants in this segment who knows this segment very good. And on the retail, Amit is there to help.
Yeah, so the idea of getting into this business is to directly deal with the client. So personally speaking, we don't deal with DSAs as much as people would have understood. So all the cases which since July onwards, almost 95% are from direct sourcing, and only 5% you can see from references or existing DSAs to maintain the relationship. That's it. So going forward also, we intend to go directly to the client by micro marketing system, and we want to build a a DSP model where direct sales is happening at the client place, and DSA we will definitely see, but not now. But once we stabilize, we have a good AUM, then only we'll look into that, because where there is a branch model, we should definitely go for direct sourcing. So almost 95 to 96% of the book is direct sourcing. Only 3-4% would have been from references or DSAs.
All right. I'll join that with you. Thank you.
Thank you. The next question is from the line of Karan Jain, an individual investor. Please go ahead.
Hello, sir. Thank you for the opportunity. So my first question was on our exposure in wholesale book. So I just want to understand, is the wholesale exposure outside India, or is it 100% NCR? Hello.
Yeah, our exposure is only in India, and secondly, mostly into NCR. You can say 95%, only 5% in Chandigarh suburb. And going forward, we want to expand into that area. But as we see the opportunity, still we have a lot of market to expand ourselves in the existing area. But for geographical spread, yeah, we will be going into that segment in that part of North India. But still, I would say right now, 95% of portfolio is coming from the NCR. The extended NCR, it's a huge area within, I would say, a radius of 70 to 80 kilometers.
Okay. And my second question is on the retail wholesale book mix. So you have guided to bring the retail to 40% of your book from the current 27% in 12 to 18 months. So when you say this, how are you looking at it to achieve this ratio? Like, will it mean decreasing our wholesale book, or you are going to increase our asset base as a whole?
Yeah, definitely, we are looking. We'll be going, and on this the extended AUM, we want to achieve that 40%. Yeah, if as a company, if we have limited availability of funds, then our first preference is to grow our SME and to bring out to a healthy mix, and we want to maintain a 60-40 in immediate 2 years, and then going forward a 50-50 mix in after 3 years. So that is our thought and on the mix, and so if there is a little constraint on the funds, then the first focus is on building the SME side.
Okay, thank you.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity and congratulations for a good set of numbers. The way we have performed during this tough times is pretty commendable. Well, if you look at our, debt equity, we do realize that after we raised funds in 2017, there was a tough period that we faced post IL&FS crisis, and now.
Mr. Gupta?
Yeah. Is it better now?
The audio is a bit muffled. If you can take the phone off speaker, please.
Sure. Is it better now? Is it better?
Yes, sir. Please proceed.
Yeah. So I was asking that, in like we have reached an equity size of around 320-330 crores by end of this year, largely driven by the reserves that we have accrued and 30 crore of additional equity that we have raised in last quarter. And you have indicated that we have plans to reach debt equity ratio of 1:3 and in long term of 1:4. So when do we see this kind of like target being reached, and how many years do you think we can reach to this optimum equity ratio of, let's say, 1:4?
Well, now I think you are asking this is a forward-looking statement. Now we are geared up for growth, and the infra in terms of team and processes and are building a completely digitalized platform is well in place, and with the rating approval coming and our we raising our the required sums, we can reach that. If that is not a limitation, then I think in next 3 years we can reach that figure easily, and the only limitation I told you is to raise funds at the right cost, and we don't want to raise funds just for making the building our AUM, and we want that we grow with reasonable names, which we always have thought, and with that we in view. So, and we are confident that with all those 2-3 years of COVID and some apprehensions about people, about real estate and the wholesale portfolio, which is, I think the people are now more accepting that our ability to do business on the wholesale side also. So, and with the fundraising which we have done in last 1 quarter and going forward, we think that we'll be able to raise a decent sum of money, and with the rating notch coming, so in next 3 to 4 years, 3 years, we should be able to reach the target.
Sure.
We are able to reach that for that. Now we are fully geared up for that. In terms of size and penetration, we are fully geared.
Sure, sure. And sir, on the wholesale side, we are largely present on the NCR side. So, do we have any plans to enter into new geographies, or do you think the NCR market itself provides a significant opportunity to increase our wholesale lending book to 1,000 crore plus kind of number?
Still, in terms of market size, there's a lot of unpenetrated market. Still, we can do a lot of business here. And one thing is that it's a very specialized segment where a domain knowledge about that particular area is required. Even if you see most of the developers, they are regional, and we want to go into the area, the next area which we are choosing is Chandigarh suburb, which is just like a mini NCR, consisting of Panchkula, Zirakpur, Chandigarh, Mohali, Kharad, and all those. So that has a decent spread of 40 to 50 kilometers. But this is one segment where constant monitoring is very important, and your domain knowledge. And we, just for the sake of geographical diversification, we don't want to do that. As our size grows, and with us, unless until you don't have a size, it doesn't make any sense to just go into new area and do 1 or 2 transactions there. So we have already built our team in that Chandigarh suburb, and they are doing the initial research and meeting the potential borrowers. So definitely in this year you'll see some few accounts coming from that area also. And with respect to our existing, we still have a lot of scope to expand ourselves. A small builder loan, I have told earlier also in my last Concall, that it's a segment which is very, very good, and if we become a little more competitive, 100 to 150 bits, we can grow that segment very, very strongly in next 2 to 3 years. So it is only IRR that is one limitation in that segment. So I think I have answered your what you wanted to know.
Sure, sure. And sir, on the branch opening side on SME, like how many branches are we planning to open in FY23, and any other new states that we are targeting to enter in next year or 2?
So in SME, we don't intend to open any more branches. Whatever branches we have opened in the last financial year, we will continue with those branches only, because there is a lot of potential which needs to be penetrated into those areas. It is always good to do businesses where your feet are firm and the team is strong. They have been trained on that particular geographies. So we want to first make these branches profitable, as well as penetrate all those.
Hello,
Members of the management. We request all the participants to please stay connected while we reconnect the management. Ladies and gentlemen, we have the line for the management reconnected. Thank you, and over to you, sir.
There was some breakdown in our building, and got this.
No issues, sir. Yeah. So you were talking about consolidating the SME branches this year and growing from there.
Yeah. So like I said earlier, so we don't intend to open any more branches, and we want to make these branches profitable from day one. So we will keep the same set of branches for this financial year. In coming financial year, again we'll see. We are not more on opening more of branches or expanding into different geographies, because what I feel that these branches still have lot to give to SME portfolio. So it is better to have around 24 to 26 branches and then perform from there. Once we achieve certain AUM of around SME book 40 to 60, then we can think of little bit of expansion. But currently we have this particular set of branches. We will continue with this one.
And normally, how much time does it take for a new SME branch to break even?
It takes around roughly around 9 to 12 months. That too on the business front. If we do a business of around 6.5 crores with a IRR of around 18 to 19%, then only we will be able to make break even.
Sure. And Rohit, given the things that you are seeing currently and the kind of spread or the kind of mix we want to have between wholesale and retail, do you think during FY23 retail growth will be more than wholesale, or you think that the traction that we are seeing on wholesale will continue during FY23 as well?
I told you if there is no limitation of funds, then the wholesale will equally grow, because we are very confident into that segment also. And we are looking for co-lending opportunities also with the various, we are doing already with one or two players, and lot of NBFCs and one or two banks have approached us on the co-lending side also. So we will never lose business on the wholesale. And so even if we have a limitation of fund, if we say, and then our SMEs are first focused, then we will build those opportunities through co-lending model also. And yes, if we are able to raise funds at the, and which we are quite hopeful also with the rating notch upgrade coming. So you can see the reasonable growth on the wholesale side also, along with the SME part.
Sure. And this last question on the increase in interest rates that we are seeing currently. So how are we able to pass on the interest rates to our clients, and do you think there can be some pressure on our NIMs in coming few quarters or FY23?
With recently the 0.4% hike which RBI has done, most of the banks have done, I think, with the State Bank doing 0.15 only. So right now we have not passed on our existing portfolio, and mostly is on the fixed basis. But going forward, whenever we are looking for the wholesale and on the retail, we are trying to bargain a little more, 50 basis to 100 basis on the basis that the inflation and the interest rates are rising. Definitely, if the interest rates will rise, we'll be able to pass on to our customers. They also understand. And so that is not a challenge that you lose a client just because you have raised interest. But if the industry, the rates have been raised by everybody, so we'll be a part of that only.
Sure. But normally this wholesale lending book that we have, these are fixed interest rates loan, and we do have some floating interest rate loans as well on the side.
It's a fixed book, but normally we don't have a 4 to 5 year kind of. We are only our book turn gets repaid on an average 24 months, 18 months to 24 months.
Yeah,
so
2 years.
Does not pose a challenge, and with working with already reasonable names, so a small move doesn't affect us, and we have already started negotiating little higher when we are onboarding a customer after this RBI rate high. So that will not be a big factor unless until we see a huge rise in interest rates in a very short span.
Sure. Thank you, and wish you all the best.
Thank you. The next question is from the line of Sahil Shika, an individual investor. Please go ahead.
Yeah, good evening, Rohit ji, and congratulations for a healthy set of numbers.
I have a couple of queries. First is, so you briefly mentioned on the new tech platform. Can you please do some detailing on the same, and where will the same help your firm in terms of growth and credit quality and decisioning?
Hi, Sahil. Thank you for your question. So to start on that, we have built a fully customized lending platform, origination platform, right from onboarding the customer on a mobile application, wherein we're doing all our preliminary fraudulent checks at the entry level only, doing all the CIBIL checks, which is helping us eliminate all of first entry level frauds. And we are on a everyday basis. The entire team is working with a set of the developers in terms of making our credit system quite robust. And then we have it fully integrated with our LMS and as well as the collection system. So our aim is to basically onboard the customers in the on the technological platform, make it 80% technology driven, and the rest 20% will be touched by the our team members on the ground, because there has to be technical visits that has to be done, the legal visits have to happen, so that cannot be excluded. But other than that, the entire credit underwriting and disbursing the cases all digitized. We are also have taken up the. We are also making our collections. I think 95% of our collections are all digitized collections. Only just few cash collections are there, which is a very few percentage, with the help of e-NACH and paper NACH. So, and we feel that our by having this robust system, we'll be able to do our credit underwriting better for our SME portfolio, and it will help the management give us great dashboards and BI dashboards and supporting.
Thanks. Second question is, so I think it was briefly mentioned a while back that you have a target of achieving 1,000 crores AUM in next 1.5 to 2 years. So what constraints do you see considering the current market and the current scenario and environment?
First, we have not given any kind of these kind of numerical targets, and we have only said that we are fully geared up for growth in next coming years. In terms of team, in terms of infra and policies, and we are fully geared. The only limitation I told you is the ability to raise funds, and for that one factor is a rating upgrade also, going to A category. And with the kind of fundraising which we are debt raising we have done last 5 months, and the way the few initial term sheets have come, we are confident that going forward that will not be a huge challenge, and we'll be able to raise debt, and growth will be there, but I will not commit to any numbers in next 18 months or 24 months. Our ability to, we are ready for that, and as you know, for us, the only raw material is money, and primarily to the debt side, and and every company strive for that, and we are quite confident that we'll be able to raise reasonable debt in next 1 to 2 years.
Thanks. Thank you.
Thank you. The next question is from the line of Madhura Nancy from O3 Securities. Please go ahead.
Good evening, sir. My question is, we have a good experience of builder finance and have a pretty good ROE in that business. So why would we not focus on that segment and grow it to 1,000 crore before focusing on other segments?
We missed the first line, ma'am.
We already have a good experience in builder finance and a pretty good ROA in that business, in builder finance business. So why would we not focus on it to grow it to 1,000 crore before focusing on other segments?
Your question is absolutely right. The segment has been performing for us for last since we started our lending, and we are very, very confident. And the only issue sometimes comes from our lenders and rating agencies that there is a little apprehension about the real estate. And I always say that how you do it, that is more important. if you understand the segment and how you do that, and you will be able to come out of in any of the situation. And secondly, we want that we have a ideal mix of both retail and wholesale, so it brings out more stability, not in the view of the lenders or rating agencies or outside investors, but for a company as a whole, because retail is a more consistent business, and the segment, we are not going into too many segments into retail. As a philosophy of a company, that we want to focus into limited domain. In the wholesale, we are primarily into real estate related segment only, and the retail, we are primarily into small micro cap SMEs where there is not too much data. The only people is one of the data, and banking, they have a limited banking, and IPR doesn't give you the right true picture. So fintech companies can't participate, can't enter into that segment, and mostly they are into unsecured segment. So we have chosen ourselves where we want to be, and this ideal mix of both brings us stability to the company and to all our stakeholders. So that is the reason. So just be in one line, can we say that because real estate is a little lumpy business, so to have a I would say right mix, so that has been a thought to do the retail and the wholesale both.
Okay, thank you, sir. In addition to this, there is we also wanted to know about the challenges in builder finance, which are unanticipated, and the risks in that business segment.
As a company, now we are more than 7 to 8 years. With every passing year, our confidence increases, and I still say, in any segment, per se maybe a wholesale segment, maybe into real estate or any other manufacturing segment, you have to have a very good domain knowledge. If you build that domain knowledge and you do within the parameters and policies of the companies, we don't see that any segment gives you a extraordinary challenge unless until we see that housing, there is no requirement of housing, urbanization will stop, the people, the GDP growth will not come, and people will not look for upgrading or buying new houses, then you can see some challenge can come. But even if that scenario will play out, it will not play out within few months. And as a company, we know how to change ourselves according to the dynamics of the market. So we don't see any major challenges per se, provided we work within our parameters and within our area of strength.
Okay, thank you, sir. I have few questions, but I'll wait in the queue.
Thank you. The next question is from the line of Ravi Goenka from O3 Securities. Please go ahead.
Yeah, thank you, sir. So just want to know, what is the number of customers which are repeat customers in wholesale business, and the player whom we have funded in past, are they launching new projects?
Yeah, you can say, in small builders that component is much higher, but our focus is to add more customers, and in this quarter and in this current financial year, the focus is to add more customers. And in terms of repeats, and then
75% are repeat and rest 20%.
75% customers are repeat. When they come out, they repay from the existing project and come out with a new project. 75% are repeat and 25% are the new one.
Okay. And we had spoken of entering markets like Chandigarh, Jaipur, Lucknow in Q4 financial year 18 call. What is the progress on that, and why has it taken more time to enter these markets?
So in the immediate next 6 to 9 months, our focus is Chandigarh suburb, and the Jaipur and Lucknow may not be happening this financial year. This we have told that in next 2 to 3 years, these are the next 2-3 target segment. The only thing I will explain you, unless until you have a size and everything that will be able to grow, and you have to build domain knowledge, and you have to do research of that area where we have already taken few persons there, and they are doing all those research and doing the Reiki work and meeting the potential borrowers. It makes no sense, and to just open a new area and start lending. So it requires 6 to 9 months of research before you start your first account. And secondly, definitely you will see that few accounts we will do in this year outside of NCR region. But mostly you have to have a decent size to go into any new area, because this is one segment which requires constant monitoring and constant meeting with your borrowers. And we have a reasonable lot of potential to grow ourselves in all three segments of affordable mid-income and small builder loan segments in the NCR itself. So, the Chandigarh suburb will be the only one area where you can see that few accounts will be done in this financial year.
Okay. And one more last question. We accept growth in NCR market more by addition of new borrowers or existing borrower taking more loans for new launches in the next 4 to 8 months, 8 quarters?
It's a combination of both. So far, always of given a choice to, if I have a limited fund, whether to take a new or old one, preference is to board a new customer, and definitely, but as Chandan explained to you that we have 75% from existing and 25% from the new one. The focus is to add new ones more on the small builder loans.
Okay. Okay, sir. Thanks.
Thank you. The next question is from the line of Dwanil Desai from Turtle Capital. Please go ahead.
Hi, Rohit. One question on liability side. I think in our presentation you mentioned that we are exploring some avenues for securitizing our book. So anything else on the liability side other than bank credit, like public NCDs or something like that, on the cards, or are you exploring to ensure good liability mix?
No, definitely we would like to look for NCDs from the public, but I think it will be a little too premature at this size and stage, unless until we have a decent rating and AUM of 1,000 plus. You see, whenever every company has raised funds through public NCDs, that have been at a little higher cost. But apart from the cost, I would say still we are little premature to go into that debt raising opportunity from the public NCDs and FDs. So these two things I think will not come in next 1.5 to 2 years. And but apart from that, we are all raising all those, looking for all those opportunities from the institutions, banks, whether from a securitization form or from loans or working capital or NCDs or any other form.
Okay. And are we kind of planning to do at least 10% of securitization kind of a number in next 2-3 years of the book, or any numbers around that?
Yeah, the trade-off between securitization and doing direct is till you have the funds and you are able to raise funds, and you are confident about your book, and it's better to do on your own book. And when you are not able to service from your own funds, then the securitization opportunities one can look at. Still, our SME book is around 100 crores as of March. And going forward, we are coming across opportunities who wants to look at our SME book and wholesale book also. And to start with, we are looking to securitize our wholesale book in next 1 to 2 quarters, a small portion of that, so that to have the flavor of securitization. The same we may do with the SME part. And going forward, as we'll be exploring in a bigger way, I would say in next year. But yes, we want to do something in a small way in both the wholesale and retail.
Okay. And one small clarification. So the ROE numbers that you mentioned for wholesale and retail of 17 and 19%, it is as per, it as it stands today, right, on the leverage front and cost to income front. Is that a right way to think, or this is like on a normalized basis you are looking at 17 to 19% number?
I'm not able to understand your question.
So your leverage is, what I'm saying is that our leverage is still less than 1.
It will have no correlation with my lending IRR.
Okay, so talking about IRRs of 17 and 19%.
Yes. Yeah.
Okay. Got it.
Thank you.
Thanks.
The next question is from the line of Saurabh Pal from an individual investor. Please go ahead.
Sir, thank you for the opportunity, sir. Sir, I would like to know what is the cost of fund of the borrowings, and what is the yield on the wholesale book and on the SME book, sir? Thank you, sir.
The cost of borrowing is around 10%, weighted cost of borrowing from 8.25 to 10%, as the weighted is around 10%. And the wholesale average IRRs are around 17% and retail IRRs are around 19%.
Okay, thank you, sir. That's from my side.
Thank you. The next question is from the line of Nikhil from Securities Investment Management. Please go ahead.
Yeah, hi. Hello, am I audible?
Yeah.
Yeah, just one clarification, sir. If we look at our ROA or ROE on a wholesale book and a retail book, would it be right to say that the wholesale book would be a better ROE business because it is more B2B, as a result the employee cost, the team strength is much lesser, versus a retail business where the team size is much larger, the feet on street is much larger, so the cost would be much higher? Or would it be like the retail would be a better ROE business versus wholesale eventually?
To some extent, you are right. In the short term, your assessment may be right that the wholesale book has a low cost to income and the ROEs of great. But whenever you're starting a retail, you have to invest, and I think in first 2-3 years the profitabilities are low, and in the intermediate period we also saw COVID and also this which disrupted our operation. But as I explained earlier, from the stability and the consistency we want that ideal mix of both is very, very good, and so the retail is more consistent, and the tenure of the loan is around 6 to 7 years, and the risk is also spread among large number of borrowers, and geographical spread also comes with it, and to have a more stable and consistent growth for us, so both segments are very, very important. And going forward, as SME, most of the cost has been built in this financial year, and going forward with a focus on productivity, as the last 4-5 months have been really very good, we think that the SME will also start giving the right operating numbers in the coming years and this year itself to start with. And so to have a right mix and more stable growth, the growth of both the segments is very important.
Sure, sir. Thanks a lot. Thanks, my question is answered.
Thank you. The next question is from the line of Madhura Nancy from O3 Securities. Please go ahead.
Good evening, sir. I have 2 questions. The first question is, we have spoken earlier about the time it takes a number of projects to have a good understanding of the markets and wholesale lending side. Can you elaborate on generally how much time it takes and the number of projects we need to do to have a proper understanding of a micro market?
Well, prior starting any area or prior penetrating into the any area, like as we have told that we are doing research into the Chandigarh areas itself. So prior penetrating into area, our basic team or the field team do the basic research and collect all the data related to the builders and what are the projects going into the particular areas. Apart from that, the credit team works on the policy part, that what are the policies prevailing onto the different micro markets and how the government policies are in support and how the authorities into those areas are performing and supporting builders. That can impact our lending parameters. So basis those things, whatever the learnings we used to collect from the market itself, we used to build our policies and then start penetrating to the market. Generally, these time periods takes around 3 to 6 months minimum on side to start penetrating into any market itself. In Delhi NCR, we are present since 2010. So in these last 10-11 years, we have built up our domain knowledge very slowly. We started with we review projects around 1-2 developers itself, and since 2017, once we are equipped with or developed our domain knowledge in and around the Delhi NCR areas, we started expanding our builder portfolio into these areas itself. So the minimum time requirement would be the 5 to 6 months for penetrating into any areas and collecting any demographic knowledge or topographic knowledge about the area itself.
Okay. Thank you. The second question is, we had spoken earlier about increasing the duration of builder book in one of our calls. Can you elaborate on that as well?
Duration? You are talking about the duration?
Yes, the duration of the builder book. Yes, sir.
Okay. Generally, what happens that we used to board any builders for the normal tenure is of around 36 to 48 months, but the book revolves itself into the 18 to 24 months for the small builder loans and the 24 to 36 months for the big builder loans. That is the normal duration.
Okay. Thank you so much, sir.
Thank you. As there are no further questions, I now hand the conference over to the management for their closing comments. Over to you.
Thanks everybody for participating in this quarter 4 and the financial year 22 call, and hope to see you again in after September results, the half year results, and thank you everybody, and thank you Sam and your team.
Thank you. Ladies and gentlemen, on behalf of CSL Finance Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.